Welcome to the Private Equity Exchange 2007, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. The Private Equity Exchange is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet, enabling them to move quickly from ideas to deal crafting. The Private Equity Exchange, the largest private equity event in Europe for CEOs, funds, and LPs. LBO for professionals. Asset allocation, fundraising, asset allocation trends, private equity secondaries.
Our objective this afternoon is to explore really some wide-ranging topics: fundraising, trends in asset allocation, and the growth and developments in private equity secondaries. And as Charles said, we are really very fortunate to have a very talented and experienced panel to help us with that. On my left is Charles Soulignac, the founder, chairman, and chief executive of Fondinvest, one of Europe's leading independent fund of funds with something around, I think, 1.5 billion euros under management. And prior to private equity, Charles has very wide-ranging experience in industry, finance, and consulting. On Charles's left is Daniel Schmidt, who is a partner with Proskauer, one of the leading private equity partners internationally, and in particular with a lot of experience in fund formation. And therefore, Daniel brings a lot of experience of bringing LPs and GPs' interests together and encapsulating that in a document. On Daniel's left is Thomas Frei, a managing director of Lombard Odier Daria Hench, one of the leading mid-market buyout investors in Europe. Thomas is on the investment committee and involved in deal sourcing throughout Europe and has over 20 years experience in investment banking and private equity, previously with Swiss Development Funding Corporation and a mezzanine investor and with UBS. So again, very wide experience. And completing our panel is Francesco di Valmarana. He is the investment director who's responsible for Unigestion secondary investments. Prior to that, he was a founder of DN Capital, a venture capital firm in London, and also was a director with Advent, responsible for buyouts in the media and retail industries. And so again, a very, very wide experience in private equity. I'm going to ask each of the panel just to introduce themselves briefly and give their perspective on these topics of fundraising, asset allocation, and secondaries. But just to get us started, I'd like to show some data on that. We see quite a wide range of percentage allocations to private equity. At the lower end, insurance companies and corporate pension plans and public pension plans, typically in the 5, 6, 7%. But by the time you get to endowments and many family offices, you can be in the mid-teens. So some quite significant differences in target and actual allocations to private equity. These are an international picture. If you split out North America, Europe, and Asia, you'd see further differences with the biggest allocations in North America. That's the current situation. If you look at what the trend is and what LPs are doing, we ask them every year, what they plan to do. Are they going to keep their allocations the same, increase them, or decrease them? And this was done in June of this year, and it's a really remarkable picture that actually is reflected in both the US and Europe and elsewhere. The vast majority of LPs are very definitely set on increasing their allocations to private equity. So only 5% of those we polled plan to decrease it. As a result of that, this chart is hardly a surprise. The trend in private equity fundraising, it's actually sometimes, I find it hard to remind myself that as recently as 2003, there was just less than $100 billion US of funds raised around the world. it's not that long ago and a very different world from today. Last year was a record. Just under 500 billion was raised by just over 800 funds. This year, it's currently about 426 billion, we reckon. We're always a little bit behind because we track the funds closed as of today, but over the next few weeks we'll find out about funds that have closed that we don't know about yet. So we still think, despite everything with the credit markets, this year is on track to be probably as good as last year. It might even just go over the 500 billion US dollar mark. For those of you who can divide blue columns by red columns, you'll see that there has been a change in average fund sizes, and that's been continuing. So this year is down in the number of funds, but the money is still there. Something is at one level encouraging for all of us here, another level quite scary if you're raising a fund, is what's on the road. We reckon there are over 1,200 new private equity funds on the road around the world, and they're trying to raise 641 billion between them. So, great news if you're an LP, there's lots of opportunity. Quite scary if you're a GP raising funds, there's an awful lot of competition. That's been talking about new private equity funds. The other big trend, not just the growth in fundraising, has been the growth in secondaries. And this chart just looks within that at global secondaries fundraising that went from about 3 billion back in 2003. This year to date is already just under 15 billion. And there's another 9 funds, we reckon, currently on the road. So that's it. I'd like to, if I may, hand over to the panel, and if they in turn can each just say hello and maybe give you their perspectives on really what's going on with allocations to private equity and asset allocation, fundraising, and what they think's happening with secondaries. We'll then get into discuss some of the issues they bring up. Charles.
Fundinvest Capital, we manage fund of fund and secondaries. We manage also mandate for institutional investor, which is an evolution in the business. We are managing investment in funds from the mid of the investment done in the mid of the 80s. So we have had a lot of knowledge with success and failure, and also a long track record in this business. We invest mainly in mid-European market fund. In secondary, we are more working worldwide. We have a team of 16 people, and half of them are professionals of the direct investment. We have investor base here in France, of course, but we have also investor from They are investor from 95 from US, from Middle East, and from Asia. What is the evolution on the market on the private equity? I will say that there is no evolution. In fact, that you have a cycle. If you come back to the mid of 85, you have a cycle. You have a cycle 85-90, 90-95, 95 2000, 2000 2004, and now we are again in another cycle. Now, for us, it is not a big issue, and a lot of discussion and newspapers and articles. It is the life of the business, and it is the life of the cycle. So this is our point of view today on the market.
Good afternoon. My name is Daniel Schmidt. I am partner at Proskauer Rose LLP. Proskauer Rose is a worldwide law firm specialized in private equity. In the United States, the practice was developed by a team originally working for the very famous structuring law firm Testa Jurvetz. In 2005, the majority of the team created Proskauer Rose in Boston. Today, the private equity team in the United States gathers about 150 lawyers, mainly in Boston, New York, and Los Angeles. Proskauer Rose decided to implement itself in Europe by creating a branch in London and welcoming an existing team in Paris. I represent the French team. The practice in Europe evidently includes fund structuring and transactional work. I would be able to talk about the US or UK trends, but it seems to me that it would be more interesting for the purpose of this panel for a French lawyer to focus on the French specificities of the topics. What are the key trends from my point of view? In our segment of intervention, small and mid caps, we have not seen any specific difficulties resulting from the current subprime crisis. The first quartile management teams succeeded in rising in a reasonable time frame funds of less than 500 million euros for LBO. That's, I think, general in Europe. What is specific to France, it's the venture capital and growth capital funds. Some venture capital funds closed recently at a significant level, around 150 million euros, which is a good success for venture capital fund in Europe. And also, as every year, we expect that the very specific French funds called FCPI or FIP will be able to raise aggregate amounts of more than 400 million euros. On the venture side, we must also point out two specific aspects. First, the existence of what we call France Investissement, which, with the help of CDC financial institution, should also invest approximately 500 million euros per year in venture capital and also in growth capital. And secondly, a brand new fund was created this summer for French taxpayers subject to our very specific tax, ESF, tax on wealth. For the moment, it is difficult to forecast the success of this new fund. Different forecasts are speaking figures between 200 million euros to 1 billion euros. So it could be very important, very significant. For the moment, we don't know. We don't know exactly what will be the very precise conditions of working of such funds, but it is something new and very important for venture capital. It is for considering the secondary market, it is evident that this market has significantly increased over the last 12 months. One could expect a major development of this segment in 2008 if the subprime crisis does not end. Effectively, in my point of view, some LBO operation could encounter difficulties in reimbursing in fine loans should they expire during this period.
Thomas Frei from Lombard Odier Hensch Group, building on a 15 years track record with UBS, as Mark previously mentioned. We built our joint business with Lombard in '98. Today, 21 professionals focusing on specialized products, specialty products, particularly in the European market, particularly also in the European mid-market, where we feel, and I think that's a first trend if I combine my introduction with trends, we started that business focusing on specialty strategies rather than on global coverage. And I think at the time, while first moving into this direction, comparing ourselves to competitors, it's probably today the standard. If you look at the providers, they start specializing very much in different type of offerings, which is just a pure reflection. And I think that's the second trend of the private equity industry on the investor side. It reflects a maturing of our investor base. I think that's also relatively clear. Why did we do these kind of specialties? Well, first of all, because I think this is an absolute return business, the opportunity, the high alphas, that's what we're looking for. And that's why we specialized ourselves, and that's why we position ourselves relatively clearly. The other point on recent trends, I believe, in the industry is I would tend to agree with Charles on the cycle. Cycle for me, however, more on the investment side. While if I look at the investors, I think we have to be very careful on what we see there. I think there is a growing investor universe, maturing investor universe of people, institutional, who do private equity, and there is still a very, very large number of investors who have not even thought about or started to think about private equity. And I think that's probably that second part is what's going to continue to make this industry grow over time. So it's less, I believe, on the investor side, a cycle thing, but more just showing that from the investor's point of view, we're still such a small industry that there is plenty of opportunities to grow. And then, to build the link back to Charles, that will happen relatively volatile over time. In good times, people will invest a lot. In peaking times, they will invest most. Those who fall on their noses, that's unfortunate, but that's just a simple fact of the market. And then, as a tendency, as a general trend, I think investors are just, pushed to grow in the private equity industry because the money is around.
Right. Francesco.
Sure, I'll take up where Thomas has left off. Briefly introducing Unigestion, we're a Geneva-based alternative asset management firm with offices around the world, about 8.5 billion euros under management. About 2 billion of that is in our private equity fund of funds business. We have about 30 people based in Europe, in the US, and soon to be in Asia as well. We have a slightly different approach to that which Thomas just described, which is many of our clients are mid-market European institutions who don't have a very aggressive or developed private equity strategy. And so they look to us to provide, be their sole provider of exposure to the private equity asset class. And so we have a group of clients for whom we provide pretty broad coverage as opposed to targeted vehicles. Global large cap buyouts, mid cap buyouts in a variety of geographies, a little bit of ventures, some secondaries. It's private equity in a box. And these are people who have between maybe 10 and 25 or 30 million euros to put to the asset class and one person covering it, not even full time. What we have seen, however, is that in hand with the growth of the industry and the development of the client base that's been described before, our clients also are maturing, getting more comfortable with private equity. And so what tends to happen is one of two things. Either they look to us to continue to provide all of their exposure, but generally in a dedicated vehicle, a single client fund of funds, and we can be much more tailored about that. Or they will look to us to provide a more targeted solution. They'll say, fine, I can manage our relationships with Blackstone or with Carlyle or some of the larger funds. I'd like you guys to do the mid-market investing in the US and in Asia and in Europe, and we'll go off and find somebody in California to do US venture for us, and we're fine with that. That's not our strongest area. And so we see in terms of approaches to private equity, some clients, and I think you're right, we've barely even begun to fully address this market. Smaller clients who want exposure, who will always be smaller clients. And there are many of them out there, conservative small pension funds, insurance companies, who should have some exposure, but they're never going to have a big enough program to warrant hiring a team to develop it in-house. And hand in hand with that, the larger investors who are becoming more confident, they go from 0.5% exposure up to 1 to 2 to 5. And we've got clients now who have 15% exposure to the asset class. The other area, and I'll quickly touch on it because we'll come back to it afterwards, is the development of the secondaries market, obviously close to my heart. But it's an interesting phenomenon. I think it very much is one driven by market timing. I think I'm going to be very curious to see what happens to the market over the next 5 years, because I think that the market has been driven by the excellent returns generated in the past 5 years, which really happened when it was a niche business and portfolios could be bought at a discount. If you look at what's happened over, particularly in the past 18 months with leverage in the marketplace and a lot of new investors in the asset class, the pricing has been such that nobody thinks purchases made in the past 12 to 18 months are going to do better than low teens. Now, certainly there will be a couple that do better than that, but on average, the portfolios are being sold at pretty scary prices. Now, we think that with the leverage coming back out of the market, the distribution slowing down, we think there's going to be a return to normality in the secondary space. And those numbers that you saw, those large fundraisings that have taken place in 2006, 2007, I think some investors are going to find that the asset class doesn't deliver what they thought it would, and we're going to see a return to a slightly different approach in the secondary market.
Right. Thank you very much. One of the things that you all mentioned in your own different ways was, kind of effectively, we are in the early days of private equity still, and that allocations will go up. Now, the chart that I put up showed, sort of allocations of maybe 7 to 10%, but then not everybody's participating at all. So there are people who've got zero. So you scale that back and say, well, maybe 4 to 5% is kind of the true average allocation. And if you look at the size of the private equity market, it is probably only about 4 to 5% of the listed stock markets. Thomas, how big is it going to go?
I believe we'll have to look at investors individually and have to look at their asset and liability side.
So it should be different levels for different investors?
Yes, totally. I think it would be obscene for pension funds, who have a mature, community of people which are insured with them, who might rather decline in size than increase, to have the same allocation than, for instance, Yale Investment Fund, you probably all know, with an allocation of 25%, or at least historically 25%. Now I think it's a little less, in private equity. That is simply a reflection, of how you manage your liability side in respect, to the assets where you invest. What typically, banks would do, except in years like we're experiencing now, as you all know, when the bubble bursts in whatever industry it is, or in whatever sector it is. But I think what we experience is really when we look at, be it, mandates or be it selling, the fund of funds, is we look at each investor individually and try to help him define his profit allocation if it hasn't been done at that time.
Right. And what would a kind of a sensible... Can you give us some examples of appropriate levels of asset allocation in your view for different sorts of it? Are there any investors who shouldn't be in private equity at all?
Well, again, this is a question which I would argue on the institutional side, probably not up to or until to a certain floor level. And then for me, investing in private equity becomes a different game. And that's at the level where, investors cannot invest in private partnerships, i.e., self-liquidating vehicles, but try to enter the private equity markets through listed fund of funds or listed funds. For me, these are two different, in a way, two different asset classes. The asset class private partnership is all about long-term investing, assuring, that at some point in time you get out through liquidation of the vehicle, and really with a long-term absolute return focus. While I would argue that on stock-listed products, which are then for investors probably in private equity who have maybe less than 5 to 10 million maximum at their disposal, I would dare consider it an arbitrage thing.
Right.
And for me, the arbitrage is the following, and we try actually also within our bank with the team to do this. You try to capture the low point for any given investor, and we all like to enter obviously in the low point, but with private equity, it's relatively good timing to enter in the low, because the price is down and the discount to the NAV is extremely high. So if you haven't gotten really the low point, but you're close to the low point, when it comes up again, you benefit of this double, whammy, which pushes at one time the price, and at the second, the reduction of the discount to the NAV, and that makes you obviously have nice capital appreciations. But for me, it's a different ballgame.
Right.
Can I step in on that and just say there's one investor who I can imagine should not be invested in private equity, and it's a very specific case, but there may be investors who can find analogies. We bought a secondary position from a pension fund, or actually it was the emergency fund, as it were, for a union. And the idea was that when the union members went on strike and they needed cash to support the union members, this was going to be their lifeboat. and some idiot had invested in a private equity fund. And of course, they went on strike and they couldn't get at the money. We were able to buy a very attractive secondary. So if you have any possibility of that kind of drop-dead event, which is going to require call on cash, then private equity isn't the asset class for you, unless, of course, you want to invest through a public market vehicle, like Thomas mentioned, which, however, means you have to be accepting of the fluctuations that these vehicles normally go through. I think anybody who is an open-ended investor with long-term requirements, long-term investment requirements, is an appropriate investor in private equity.
Right, right. Now, in terms of the first foray into private equity of the people coming into the asset class now, and we've seen, I mean, our database 18 months ago had 2,800 investors on it. It's now got 3,600. So there's a lot of people coming in for the first time. Are most of them coming in through the fund of funds route? Charles, is a lot of your investors, are you their first sort of port of call through a fund of funds?
We have the both. We have the small LPs, and we maintain a minimum of 2 million euro, which is very low to have our historical investor. They invest regularly, and this it is, as you said, it is a lot of investors that could come in this business that is now recognized an asset class, and this it is one of the important points. The second type of investors that we have, it is in some case investors who are very large, but they don't have the human resources to do the business. And they invest, for example, in the large fund like Permiras, in CVC, and so on. And after, they want to have access to some geographical area or some type of investment. And they go through our fund of fund. We have also foreign investors who want to have an exposure to Europe, and they go also through fund of fund. But also what we are in the process to develop, it is the mandate for large institutional who want to develop their asset allocation in terms of geographical, but also in type of investment, early stage, development, LBO, small and medium-sized LBO. And this is why we have this type of mandate that are increasing in comparison. But it is not new in the business of the fund of fund, because when you look at the early in the 80s in the US, it was this type of business. It was the gatekeeper business, and,
right.
And so it is not very new. Some say it is new. No, it is not new.
Now, as we've also heard this afternoon that the universe of investors is maturing and getting more experienced. How are you guys in the fund of funds world? How are you evolving your offering to stay relevant to those increasingly expert and experienced LPs?
To increase and to continue to have our investor, first of all, it is the performance. And right. It is not easy for some fund of fund to show the performance because they are in the business from some in the 90, 97, 99. So it is very young to show the performance. And this is one of the first points. They are here to have a performance, to have a diversification. When we discuss at the end, they don't care. To invest in early stage growth of LBOs, for them it is just performance, and they look only at this, which is, I think, one of the important point that they have.
What that they should be looking at diversification across different parts of the private equity.
Yes,
sphere.
They are trying to do this and to also to have their own program of investment.
Right, I see. Okay, and Francesco, does that accord with your kind of experience, and how is Unigestion, developing its offering in that?
Yeah, I would generally speaking, yes, I would entirely agree with that. I mean, I think that as our investors mature, I think there are two axes along which we have to change our offering to them. One is what's just been discussed, is at the product level, and maybe they've decided they want to take certain large relationships in-house and will continue to focus on the more niche or specialist areas for them. The other area which we've seen, which is an interesting one, is often comes after that, which is at the service level. And many times these institutions, their exposure to the asset class may grow, but they may not actually want to allocate any more resources in terms of personnel to it, in terms of back office management to it. And so, they'll come to us potentially, or somebody else, with a single global fund-to-fund solution that then morph into several direct relationships, plus a couple of fund-to-funds, plus some secondary funds. And next thing you know, they've got a full-time cash management solution with the drawdowns, with the distributions, signing all the various documentation to go with these deals. And that is when we see them come back into the fold, as it were. And they say, and this is the case with the large client mandates we run. They say, look, can you take it all back in-house? In several cases, we'll include third-party fund-to-funds in the vehicle that we're managing, because they're specialist areas. Again, I cite U.S. venture. But the offering there is not really any more the diversification, because there's plenty of that available in the marketplace. It's the managing of the cash, the call downs, maintaining exposure at your target allocation, all of the more strategic elements.
So in fact, you've sort of morphed from being effectively a pure fund of funds manager to sort of outsourced management of a private equity portfolio as well, in addition, in addition to that.
Yeah.
Thomas, what are your thoughts on that?
This is a very important point, I believe. There is a general trend probably for investors, relatively mature investors, who are probably not expanding their GP base, but keeping it stable at best, because they have found out that it's relatively tricky, to consolidate the portfolios themselves, and, they tend to outsource it or try to find these kinds of solutions. This is obviously one area to push forward. But then what we have noted, and I think that's what I initially also said, on, positioning yourself in a specialty and building on that specialty. This may be, having started in Western Europe, then expanding to European Union, then, growing with the European Union, then, maybe having done buyout and growth, and then adding special situations, turnaround, because that's a very exciting sub-segment, I think, in the private equity industry, if the cards are nicely played. And a very interesting experience, and that pushes actually in that direction we had when we set up the business anticipated, is that quite a bit of the private equity industry on the investor side is also consultant-driven. If you go in certain countries, actually it's very, very consultant-driven. And you can see there that the countries where consultants were the big drivers of building private equity portfolios for their clients, it was almost exclusively global coverage at the beginning. Because, also consultants, and I'm not trying to offend any of them if they're here, they have a sort of an operational model which has to be efficient. And for 5% of the total assets under management they advise, they cannot build units, of 50, 60 people, to advise their clients. So what they've done in the first round is having an overview of global fund of funds provider. And then suddenly they found out that this is not enough, and actually that, private equity is really an absolute return business, and that it would be probably worthwhile to go for specialties, opportunity-driven things. And they've started to enlarge their analysis of the universe into specialties where they mostly work with fund of funds, and enlarge it on the other side for the mega buyout funds or the very large other funds to advise their clients actually on the direct access. So I think that's a very important trend we have experienced over the last 4 or 5 years, which I would assume to continue and probably even to reinforce itself over the next few years, not the least because of the recent crisis we have been experiencing.
Right, thank you. You made some very, very interesting points there. One right at the beginning, you mentioned, Thomas, the fact that many LPs are not expanding their base of GPs that they work with. In fact, in many cases, it's obviously it's the contrary. They're wanting to focus on a narrower kind of core group of GP relationships. And I think, Francesco, that probably comes back to the kind of whole secondaries argument. And you mentioned one trigger for a secondaries, kind of transaction that was somebody who had no business being in private equity at all. But there are other triggers related to people who want to actively manage their portfolio and perhaps focus on a core group. Do you want to sort of give us your views on those sort of opportunities?
Sure, happily. Look, I think that there are really kind of two drivers of secondaries. There's forced sellers and voluntary sellers, right? And the forced sellers don't exist today because the distribution, well, hang on, they didn't exist 6 months ago. Today we have a slightly different situation. I'll come on to that. But you had very many sellers of choice, and you had sellers of choice because you had so much secondary money being raised. You had leverage on top of that as well. You had pricing being pushed to these levels that I cited before. We as Unigestion actually sold our first fund of funds into the secondary marketplace at the beginning of this year. First time that's been done. And we did that because it was a 10-year-old fund of funds, tail end. We saw some cash coming back, but really not masses to justify our additional layer of fees. We sold it to a buyer who we know very well, who has a structural advantage at a whopping premium. It was a great deal for everybody. But that only works so long as the pricing allows sellers to sell at a premium or at NAV. And I think that's why you've seen these very large deals, CalPERS selling, MacArthur Foundation selling, Hughes Medical selling. These are large, long-term investors in the asset class who are hiving off the 50% of their business that's in smaller managers they don't want to follow. But they're not going to do that if they have to do it at a loss.
Now, one of the things we've seen in the listed market is that many listed funds of funds, from having been trading at premiums or thereabouts, are now trading at discounts. The secondary market is following that. I wouldn't say that overall it's trading at a discount yet, but it seems to be, from the last couple of transactions we've worked on, trading at or near NAV, which is certainly 5 to 10 points below what it was, in the summer. Hence your comment that we may see a bit of a hiatus in the secondary market, or a bit of a slowing down.
You're going to have an overhang from the large funds. Collar, Lexington, Pantheon, they've all been very big investors or big fundraisers, and that money has to get put to work. But I do think that that's going to get mopped up by an increase of supply from the market changing. Right. And then we'll see what happens. Give it 18 months.
Okay, interesting. Daniel, can I just bring you in on secondaries? Because obviously the way the partnership agreement is framed has a big impact on the ability of an LP to consider a secondary transaction. So what's your kind of perspective on that?
Yes, that's sure that the way you structure your fund could seriously influence the investment of LPs. Once again, I will speak mainly on the French aspects of the question. For the moment, I think that in France, no specific fund will be created in the secondary market to make secondary operations. And we are waiting for that. Some classical fund of fund are making secondary operations so far. But I don't think that there is a specialized fund created exclusively to invest on the secondary market for the moment. Of course, it could be very different because the way of investing, the way of drawing down the money will be very different, and is very different.
Right.
The different fund you can find in other countries than in France.
Thank you. I'm afraid we could continue, but I've just been kind of waved out. We're sort of running out of time, so I hope you'll join me in giving a round of applause to our panel members. Thank you very much.